Teal's first idea is TD Bank. This is another one, a bit like Bank of Nova Scotia under a cloud. Their First Horizon acquisition in the States didn't go through.
That's correct. And it's also sort of, we started off the show talking about Canadian dividend stocks appearing attractive, and so TD is one of them. And it's rare that you ever see TD Bank trading less than 10 times earnings or a dividend yield close to 5%. Yeah, that's what you have. It's trading around 9.6 times this year's expected earnings and a dividend yield of 4.7%. And it's also, TD Bank is historically, has always been sort of ranked within, along with Royal Bank, as the number one or number two most premium priced bank stock. And yet today it's ranked number 3. Behind Royal Bank and National Bank in terms of its PE multiple. And so it's about 15% below Royal Bank, when historically it's closer to even or maybe down 5 to 10%. And so it's tracked. And also TD Bank is also the most capitalized bank of the big 5. It's got about $16 billion of excess capital, largely because of the First Horizon Bank fell through.
Yeah,
exactly. So they got all this excess capital. And they decided immediately, well, they'll use about $2.6 billion to buy back 30 million shares, and they plan to do that by the end of the summer. And so when you combine the 4.7% dividend yield, a 1.6% share buyback that's occurring in a matter of just a few months, you've got the undervaluation of the company. It all points to capital appreciation going forward.
Okay. TC Energy, another stock that's been out of favor, a big dividend yield.
Yes, and this is a 6.7% dividend yield. Now, management's guided to about 3 to 5% dividend growth over the next, I guess, 3 years or so 4%. So if you bought TC Energy and you're earning a 6.7% dividend yield, and you got 4% dividend growth over the next few years, that's a total return of about 10%. Now, what's actually more interesting is that if you look at a 10-year chart, you'll see that TC Energy has these high oscillations, these wide swings. And it was about, there we go. So about 12 and a half months ago, it was at $74. And so it's around 53 and change today. So if it took 3 years to get back to where it was 12 and a half months ago, that'd be about a 38% gain in total. And so about 12% a year over 3 years. Then you add the 6% dividend yield. You're looking at 18% annualized returns over 3 years. And not bad at all. And management seems to see the opportunity because there's been significant insider buying over the last year.
Okay.
Yeah.
There are some people who say insider buying is more important than selling because people have to sell for all kinds of reasons: estate planning, diversify, etc.
Oh, yeah, exactly. You have multiple reasons, but you only buy for one. You expect the share price to go up.
And then finally, Aritzia, out of favor right now. It was a go-go stock for quite a while.
Yes, Aritzia last month, they announced strong quarterly results, but then they also provided guidance that they're going to be increasing their investment spending to support their industry-leading growth. And so that was going to impact margins this year. And so the stock fell quite sharply. But these capital expenditures are considered to be, and these investment spending expenditures, one sort of just temporary basis. So management expects the margins to return to their prior levels next year. And so if that happens, then the stock should get back to where it was before the recent announcement, around $43, which would be a 20% upside. Now, that's just the return of the margins back to where they were. The company is also growing their square footage about 15%. And so if revenues increase and you get the same margins, well, that should actually increase their earnings. So you should see higher than 20% return on the share price, probably closer to 30.
Risky, though, isn't it? Because it's a bit like show business. Will they have the right clothes in the stores? I know they're not probably as fickle as a Zara or an H&M. Yes,
they have a lot of what they consider staples or core products, which they are more reliable in terms of the customer purchasing. And so they have that, but they've been doing this for many, many years, 35 years. And so they've really got the rhythm down, and they've been pretty meticulous and methodical in their expansion. And so I'd say the odds are probably higher with this apparel retailer than a lot of others.
And of course, you're based in Vancouver and they're from there.
That's correct. So we've seen them grow over the decades.
Yeah. Well, Teal, thank you very much indeed.
All right. Thanks for having me.
First idea, Fairfax Financial Holdings, Prem Watsa's company.
Yes, we alluded to this just before the break. This is the parent of Fairfax India. It's a great company. The stock price was sort of flat for a while. We got in the 400s. It's now almost up to $1,000. They've increased their premiums by about 16% in the past year. And what we really like is, as an insurance company, they're managing their float. So they're taking in premiums that people are paying for their insurance policies every month, and that's being invested in very short duration fixed income. So what that means is they are not very exposed to interest rate fluctuations, in the sense that the short duration can earn the highest rate because the yield curve is structured in such a way that the earliest, so I'll call it the 1 month, 3 month, the 1 year bonds are paying the highest rate. And they're very flexible. So if rates do get cut in the future, they can move out the curve and they can benefit from that.
Your next idea is Danaher, involved in a whole bunch of science sectors.
Yes, that's right. So we like Danaher because they will get you coming and going, no matter what sort of drug you're making. They work with the branded drugs, and they are integral in the part of the FDA approval. So if you have certain Danaher products involved in producing a drug, you have to have that exact same Danaher product involved all the way through. But what's also happening now is there's about $200 billion in earnings from the big pharma that's hitting patent and coming off. So now we're going to see a lot of generic companies coming to market with generic competitors that'll be cheaper than the branded pharma. And in doing so, Danaher will be called on so that they can produce basically the same drug, but for half the price. So in general, as drugs are produced, Danaher wins with the branded companies as well as the generics.
It's interesting. So they're a healthcare play that people might not think about.
Right. It's kind of like the picks and shovels to all the drugs coming to market. And we talked about Novo at the top of the show. They have really good R&D. They know how to bring drugs to market. But there's a lot of drug failures that happen along the way. Danaher still benefits because they're working on phase 1, phase 2, and phase 3.
It's interesting. I see the stock is off its highs.
Yes.
Did it run up with all the spending on the COVID vaccine?
So there's been sort of a lagging effect of COVID as it's come off. But I think if you look at the business now and you compare it to what they can do next year, we're going to look back in the summer of 24 and say, hey, Danaher was quite cheap. We got in the 230s, 240s. This was a good price to buy.
Right. And there's still plenty of COVID vaccine activity in the industry. That hasn't gone away by any means.
That's right.
Yeah. And then finally, Teleperformance. Where are these guys based and what are they all about?
This is a French stock, so it trades on the Paris Exchange. If you've called customer service for any company, you've probably talked to someone in a different country, someone who probably worked for Teleperformance.
Wow.
So they have about 400,000 employees all around the world that handle call centers. The stock's come off significantly, and we can see it on the chart here. There's been sort of 2 big drops in the past year. One was an issue with the labor practices in Colombia. That looks like it's going to be sorted out. It's maybe more so around the Colombian government, the new parties that empower, and what they're trying to do to businesses there, than actually something that's happening with the company. But this is a company where if you just think about 400,000 employees on the phone every day talking to consumers, trying to sort out your hydro bill or your heat bill or whatever it may be, they have a massive trove of data. And they actually announced this morning that they've signed an agreement with Microsoft to use Microsoft Cloud and Microsoft's AI product. So they're going to be able to start to have a machine on the other end of the phone talking you through what it is your problem. So, and I know, you're sort of looking at me and saying,
sounds so annoying.
I've used a chat bot before and they don't work, but they have all of this data. They've recorded all these calls. And so they're going forward, be a real big beneficiary of AI in a way that it's not just going to be a chip that gets sold, but it's going to be on an ongoing basis. It's really going to impact their cost structure and make things better.
Yeah, I mean, we will get to that famous Turing test where you can't tell if you're talking to a person or not. Yeah. Okay. Yeah, I guess that era is coming.
I think it's in front of us, right? Yeah.
Brett, thank you very much.
Thank you.
Brett Gerard. Let's get to the top picks. Amazon.com.
I think the stock's up near 50%, so you got to be wondering why
this year.
this year. Why in the world would I be picking a stock up so much? But I'm not looking at the current price or the current movement. I'm looking at the long-term potential for Amazon. I'm looking out the forward windshield, not the rearview mirror. And obviously, Amazon underperformed in 2022 dramatically. I think new CEO Andy Jassy is doing all the right things. He's focusing on cutting costs, keeping things under control. And I think it has exposure to two of the most fantastic growth areas going forward, e-commerce and cloud computing. And the demands for AI, the requirements for cloud computing are just going to be incredible going forward. So Amazon stock, worries. I mean, it got ahead of itself. All technology stocks did. Multiple compression because of interest rates. But growth will shine through in the long term. And we can see in a couple of years, of $6 a share of free cash flow. I think great businesses tend to trade at a free cash flow yield of about 3%. If that's the case, Amazon is a $200 stock a couple of years out. So we're sticking with it. If it's from 125 to 200 in a couple of years, that's going to be a pretty decent return, even though the market cap is, $1 trillion plus. We see no end in sight to the continued growth of Amazon. And if it keeps costs under control, the free cash flow per share is going to grow. And that's why you buy stocks, growing free cash flow per share.
Stryker, the medical device maker.
Yeah, so Stryker is finally, things are back to normal in terms of hospital staffing, in terms of the reopening of the world. And to me, this is the best way to play the aging population. Stryker is the market leader, has the best products, the best relationships with surgeons. It's a leader in hip and knee replacement. And still really mostly North America and Europe centric, so lots of potential around the world. I mean, people get older. I've noticed so many people recently have got their hips or knees replaced, and they're back to normal. My wife got her hip replaced in October, and 3 months later, we were in Costa Rica, and she was scuba diving. So
good. Wow.
It's just tremendous, the technology, and probably Stryker I don't know what product she had. She didn't ask for a Stryker hip, but the surgeons are the customers, and they have the best relationships with the surgeons. So we still see tremendous growth going forward for Stryker.
That'll be the next thing. We'll see them. Maybe they do it in America already. Advertise, get your hip from us.
Yeah, possibly.
Yeah. Anyway, FirstService, play on real estate, mowing the grass, and more complicated services.
Absolutely. Yeah. They work with condo boards and multifamily boards you hire them to do everything for you. They don't actually have the employees that do the mowing of the grass or the security guard, but they help you hire them, and they have, given their size, they have the economies of scale, the buying power to help you. If you live in a multifamily unit that's run by FirstService, they take care of the billing, people moving in and out, setting up the gas, you name it. But really, this is a compounder. This is a company that is a serial acquirer in terms of real estate, property management, which is a near recession-proof business. You need to, the condo board needs to have, needs to pay FirstService or another company. One of the things with climate change, there's been more tornadoes, more hurricanes, more weather damage. It's building a juggernaut in terms of restoration business. It's called First On Site, and we think that there's more potential for it to build a tremendous national player in restoration as well. And still very small market share, not cheap valuation, will never be cheap valuation, but we think one of the greatest Canadian success stories and still in early innings.
Yeah, I'm looking here. FirstService has a thing here on their website, annual tasks for condo boards. I mean, just give me somewhere to live. I don't want to be involved in a board or anything, but some people love that.
Some people love it. Someone has to do it, and most people on it have jobs, they're retired. They're not going to take care of doing all the paperwork and setting it up, so you hire a FirstService. Yeah. Their contracts are, inflation plus, so the pricing goes up every year. And if you don't like FirstService, you switch to Andy's company. Eventually, FirstService is going to buy Andy's company anyway, so you'll be back with FirstService.
Yeah, I mean, they say here this can be overwhelming, but you aren't doing it alone if you hire a professional property management company.
Exactly, and they're the biggest, they have the most experience, and that's the company you want to work with. You don't want to work with a startup just because they're a few bucks cheaper for your condo. That doesn't make sense. The incentive is to have the best run condo or multifamily, gated community, and so you want to go with the market leader.
Barry, thank you very much indeed.
Anytime. Have me back soon.
first idea is Amazon.com.
Yes. So there are a number of things we like about Amazon. One is that for the first time in 20 years, Jeff Bezos bought a share, but he only bought a share. So
What was
I
that
don't know.
about?
I think it was sending a message. But let's go to the more serious stuff. It's had a strong one-year return of 18%, year-to-date return 49%. It's trading at 2 times sales. And you say, well, that's lofty, but NVIDIA's at 40 times sales, Tesla's at 10 times, Meta and Google are at 5 times. So in that tech environment, it's cheap. Where we think the upside is, they've got 37% of US e-commerce. Walmart has 5, Shopify has 6. So to the extent this e-commerce trend goes, Amazon's a big winner. They overbuilt during COVID. They added, and they've now reduced 27,000 corporate staff. They've closed warehouses. So they're focused on margin now, not sort of growth in that way. Their web services are a plus. Prime Video is a plus. And their grocery business, which is a tenth the size of Walmart, but it's growing, and we think they may add some interesting services there. So we think they've got a number of different businesses, all of which have some good potential.
Eli Lilly, they have a hot weight loss drug out there, and apparently tomorrow there's going to be a conference. They and Novo Nordisk will unveil their next generation weight drugs.
Yes, we own both of those companies in our health fund. And so I picked Eli Lilly because it's a better known name here. Novo Nordisk is a Scandinavian company which has an ADR on New York. It's actually the maker of Ozempic, which is the one that everybody knows. Mounjaro is the one that Eli Lilly makes. Mounjaro is only currently licensed for diabetes, not weight loss, but the way healthcare works, once a drug is approved for one use, a physician can prescribe it for other uses.
The off-label.
The off-label. The thing about this is obesity is a, not to make a pun, it's a huge global problem, and it's a problem in the affluent countries. And we haven't been dealing with it very effectively. And this drug, or this class of drugs, which have come in very rapidly, and there's a legitimate concern about what are the long-term effects, but they're injectables so far. And the thing about injectables is the patient actually got the drug, took the drug, whereas with pills, they may or may not have taken them, which makes your ability to track things more difficult. And the weight loss is dramatic. People lose 10, 15, 20% of their body weight really rapidly.
And apparently it helps with addictions in some cases too.
Yes, and it reduces diabetic risk. So these drugs are about to become a huge piece of business for Lilly, they already are for Novo Nordisk. And we think they're going to get an approval on the Eli Lilly side for weight loss. Right now, they just have an approval for diabetes.
Yeah.
And I think they're going to be really, really widely used. And unless some real problem shows up in the longer-term studies, they are going to be very important drugs.
Tourmaline Oil is your last idea.
Yes, and Tourmaline, although it's Tourmaline Oil, is actually entirely a natural gas producer, which they maybe want to change the name at some point. But it's our largest natural gas producer. It's a fantastically well-run company. We bought it first at $19. We trimmed it all the way up to $80, and it's back to $60. Why do we like it? Natural gas prices are very low. We don't think they'll stay low for all that long because there's 2 peaks now. There's a winter peak when it's used for heating, and there's a summer peak when it's used for air conditioning. And the world is getting warmer, and there's more use of air conditioning, and there's more nat gas being used to generate electricity. But the sleeper issue here is natural gas is cheap in North America, very expensive in Asia. Japan and Asia pay way more. Tourmaline has found a way to ship their nat gas as LNG through the Gulf of Mexico. And they're getting really, really good margins by doing that. 2 years from now, when the LNG plant opens in Kitimat, they'll be able to ship direct. And the final thing I like about them, if you're looking for a legacy to put in a very long-term, like your grandchild's account, they have 75 years of drilling locations.
Wow.
That they own and that they have information on.
So they don't need to do acquisitions to...
They don't need to do acquisitions. They don't need to do a lot of development. I mean, they don't need to do a lot of exploration or any. And Mike Rose, who runs it, has been a fantastic CEO, has got them good pipelines down into California. So when it gets hot in California, they buy a lot of our natural gas.
Michael, we better leave it there. Thank you very much. We should have you back to talk about healthcare policies.
I'd love to do that.
I find it so fascinating. Thank you very much indeed for joining us.
Great pleasure. Thank you.
First idea, Alimentation Couche-Tard. And I think their quarterly results are coming up pretty soon.
That's right, Andrew. They'll be reporting Wednesday, either before the open or after the close, I don't recall. But their fiscal year ends in April. So this is probably now a household name. It wasn't when I first started owning and following it in the late 90s. It was a small cap company focused in Quebec. But it's now the world's second largest convenience store chain with 13,000 stores spread across Canada, the United States, Europe, Hong Kong. And what their basically strategy is to use their procurement scale to price sharply on fuel and then have attractive, well-merchandised stores to lure customers in when they pay and sell them merchandise like hot dogs, cigarettes, candy, frozen drinks, what have you. And the in-store merchandise carries 3 to 5 times the gross margin that the fuel that they sell outside of the pumps does. So a very capable, sharp, lean operator, also a very capable acquirer and consolidator of this still very fragmented industry. They're the number 2 player in North America, but there's 150,000 convenience stores in the United States. So a lot of them are mom and pops, and there's just lots of opportunity to keep adding to the network. They recently unleashed a pretty big deal buying 2,200 stores from Total Energy, the French oil super major, to put them on the map in Germany, Holland, Belgium, and Luxembourg for the first time. They're very shrewd acquirers as well. The deals are always strategic, synergistic, and accretive to their earnings. But increasingly, their growth algorithm is shifting more to organic growth with increasing merchandising sophistication, data analytics, loyalty, apps and gamification, that sort of thing. And over time, we think that sort of shift of the pendulum towards organic growth should lead to a re-rating in the shares higher. They've grown earnings at a 20% compound rate over a decade, and they traded in mid-teens multiple. So great grower, very undervalued, and just a great total shareholder return candidate for portfolios. So we like it and own it.
Constellation Software, in some ways similar, has grown by acquisition at a massive scale over the years.
Yeah, this is a huge company, but not at all a household name. In fact, notoriously tight-lipped and even perhaps some might say non-communicative with the investment community, but a very strong shareholder base that no one understands the story and the strategy and the management team very, very well. In some sense, it's like a private equity firm masquerading as a software conglomerate. So what they do is they're a serial acquirer of what's called vertical market software companies. And vertical market software is software that's specifically designed for a narrow use case in a particular industry. So imagine like a vet clinic or a dental clinic or something like that. Whereas horizontal market software can be used across any industry like Excel or Word or what have you. So they do a lot of small deals, some so small they don't even disclose them. I think it numbers somewhere around 100 a year. This company has also grown earnings at better than a 20% pace per year compounded over a decade. I think it's 23%. And most of this growth is inorganic because most of these companies are sort of slow, sluggish organic growth companies. But we're agnostic as to whether growth is organic or inorganic, and so we like and own the stock at a meaningful weight in our portfolios.
And finally, we're a bit tight for time. UnitedHealth, the huge American health insurer.
Right. So this is number 5 on the Fortune 500. Most of the business is health insurance across the various different categories in the United States, and the rest of it is health maintenance organizations. They make acquisitions as well, but mostly they just benefit from secular growth given demographics and morbidity and healthcare inflation and scale advantages that get bigger over time. It's compounded earnings at a 16% compound rate over the last decade. It's recently pulled back amidst basically the unbottling of deferred elective surgeries like knees and hips and so on amidst COVID, and that's pressuring their medical cost ratios. We took opportunity to add to our position as we saw it trading briefly below 18 times earnings, which we think is a compelling valuation to add to our core holding in the name.
Brian, thank you very much indeed.
Great to be here. Thank you, Andrew.
Brian Madden, closing out market call for the week.